Hi everybody, thanks for joining us on another interview on our Minorum Gold YouTube channel. Again, we have a great guest, Mr. Jonathan Wellum of Rocklinc Investment Partners. We've had him on the segment several times. Jonathan, how are you doing?
Doing very well, Sonny, and looking forward to our conversation and talking with your listeners.
Absolutely. You know, you do issue these newsletters, and your most latest one was the September issue, and you had laid out some very interesting points on what's going on in the market. You've seen over the last year over year, we've seen the Canadian US dollar up 1.63%, oil 6% up, gold 18%, silver 31% up. But the 10-year in Canadian and US 10-year as well is down, but down 50 basis points or more. What have you kind of observed in the market so far over the last year?
Well, when we do the write-ups, those newsletters, we write our quarterly newsletters, and it's always good to know that we've got some great readers like yourself, Sonny. But we try to sort of look at the overall markets and then how we are positioned and how we're behaving, if you will, within that context. So a lot of the statistics that I put down in that chart, which I like to replicate, those are important statistics to our clients because they're in US dollars and Canadian dollars, and they're wondering about the price of oil, which of course has a big bearing on our Canadian dollar and things like that. And I'm not necessarily a large commodity investor, but because of the concerns within the global financial market and all of the debt and so forth, which we'll probably discuss in a few moments, I do focus my attention on gold and silver as sort of monetary substitutes and what they're doing. And therefore, I'm very much interested in gold and silver and investments in that space as protection and hedges against some of the craziness that we see with the central banks and the very loose monetary policy. So when we look at those statistics, that's what we're focusing on. It is interesting. Gold, after being shellacked from 2013 on, finally started to show some strength and has bounced back. And we're in the middle, even as we're speaking, it's come off a little bit. But we view it as a very strong commodity and a place to be given the context. And also silver, which can be a wild ride. And it's certainly not for the weak of heart and the weak of stomach, but if you're a good long-term investor, we think there's some great returns in some of those places.
And your portfolio has done quite well. You do invest across several different industries, such as infrastructure, real estate, water, industrial, but your best performing group has been the precious metals, up 77% in your portfolio. But you focus really on the royalty companies, and why is that?
Well, a couple of things, just to dissect a couple of your comments. First, we are investing and think it's very important for investors to have reasonable diversification, number one. And so we're looking after segregated accounts, and we have virtually all of our clients' financial assets. So it's very important that we're not overly concentrated in just one area because, you can be wrong for shorter periods of time. So we do try to look for complementary areas that are consistent with our big concern, and that is the devaluation of our money and the excessive debt that's in the system. So if we can buy well-financed infrastructure projects, if we can buy good real estate, we can buy good water assets, what we're trying to do is buy businesses that have strong underlying balance sheets and are backed by assets that will hold value over time, even in a stressed environment. So the best by far, though, has been certainly the precious metals this year. And when we look at the precious metal space, we're trying to look for cash flow generators. We want cash. I love cash. I want to see free cash flow. Of course, I want that cash flow coming off of assets that are going to be there long term. And so that's why we like businesses that generate strong cash flows from sale of gold and the mining of gold, the production of silver, and so forth. From my perspective, I'm a finance guy. I'm not a geologist. I'm not a miner. And so for me to pick individual stocks and mining stocks is a little bit more tricky. And I think if I were to do that, I might look more at an ETF or look at some of the products that are out there that group a handful of strong miners. And so what we've opted to do is buy into models that we understand as finance people, and then step on the shoulders of of experts who can understand the geology. And so the royalty companies or the streamers, we like those models because they give you good diversification across different mines, different geographic sectors, so they can minimize political risk, and they should be run by individuals who can pick great long-term opportunities and finance, mines that are going to be around for the long term. So, and what we found the last, 3-4 years is that because the precious metals that whole area was just so, hit so hard, that the opportunities to finance some really great projects has catapulted some of these players like Franco-Nevada and Silver Wheat and even Sandstorm, the smaller company that we own, and also Wellum Gold. They've been able to do wonderful deals so that going forward, we think that there'll be great cash flow generators on the backs of what we believe will hold value, and that'll be gold and silver. In fact, we think it will go up relative to our currencies.
Okay, and based on the newsletter, you're quoted as saying the best investment in this environment is an investment that can protect your purchasing power and has minimal counterparty risk. And I guess that leads to my next question regarding the three financial challenges that you wrote about in the newsletter, which was increasing debt, low-level interest rates, and continued money printing. And you can kind of tie it into what we're experiencing now in the markets going into the new year.
Yes, again, we are longer-term investors, so we're not trying to guess, the next week, the month, but we're trying to step back and be as objective as possible, think outside the box and say, what are the dominant impacts on the financial market? And I think number one clearly is the level of debt that's been accumulated over a number of decades. And even just recently, the IMF just released a report talking about $152 trillion US dollars in debt. And, this is from the IMF telling us that debt's increasing at a much faster rate than GDP. So we all know that's not sustainable. Recently also in The Economist, they talked about the unfunded pension obligations, over $78 trillion within the 20 OECD countries. So if you take some of the wealthiest countries in the world, they actually have an unfunded pension obligation that is estimated over $78 trillion. So when we look at debt, whether it's personal debt, and we know all about that in Canada, personal debt levels are off the charts, whether you're looking at sovereign debt, the reality is it continues to increase at a much faster clip than GDP. And we're at that point where we agree with Ray Dalio and some of the other players that are coming out talking about this, that we're close to the end of this debt super cycle. And so we need to be very careful because ultimately getting out of this is going to be very difficult. That leads to the low interest rates. How are they able to build up such a massive amount of debt? Get the interest rates down. And so, these low interest rates have been wonderful for debtors, but they are punishing and crippling for savers and for banks and for pension fund companies that, their returns have all been chopped down. You can't make the same margins in terms of interest spreads on banks. And for the average saver, it's virtually impossible to build your nest egg and build up your capital. And so these low interest rates, yeah, great, keeps this debt game going, but it's really causing massive misallocations within our economy. And then the last part of that fits into all this, how do they get the rates down? How do they continue to pump the system? Well, they print money. So they use, the printed money from the central banks to go in and buy across the yield curve and pull the interest rates down. And we just look at that and say, this isn't a sign of health. It's not a sign of any kind of stability. This is a sign of desperation. And therefore, as investors, if we have to compete with central banks, that's not a good thing. So we want to step away there. Look, we want to buy in areas that will be able to withstand this onslaught from the central banks. And when they have to step back or when confidence is lost, we've got to have access and be invested in things that will hold value and be able to withstand what we believe are some of the storms that will be coming down the pipe.
What is that event that will really be the conclusion of all these factors coming into play? Like, is it a banking system that will collapse? Is it an economy that will collapse?
Well, I think there's certainly an argument that we are in some uncharted territory. We've not seen negative interest rates before, and you know, as we've talked about before, I mean, there really is no such thing as a negative interest rate. This is really a tax on your money. They're charging your money. So we've not seen that before, and there's 12, 13, 14, 15 trillion of government debt that trades at negative yields. That's insane. And so that's something that's unprecedented. But in terms of answering your question, what would trigger a major, devaluation, a major problem in the markets? I don't know what will be the trigger for that, but I look at all of the information and say, well, you don't need to know the specific, black swan, if you will, using that terminology. You don't need to know the specific black swan to know that you need to be prepared. And so what is the straw that breaks the camel's back? Don't know. What's the snowflake that causes that avalanche? I don't think anyone knows. Otherwise, we'd all be preparing for it. But the current situation has to change. You just can't keep buying, more and more debt. You can't buy stocks. As we've talked in our newsletter, the thing that's very concerning now is that the central banks aren't just buying government or sovereign debt, they're buying corporate debt. Not just buying corporate debt, they're buying mortgage debt. Not just buying mortgage debt, now they're buying stocks, and they're becoming major shareholders in stocks. And this is a complete turning upside down of the market mechanism when you can print money and then go in and buy businesses that are tangible. And so, this, from our perspective, that's the reality we live in. So how do we go about protecting ourselves? Buy things that will hold value when it gets a little rocky, so that we can, as we entitled our write-up, batten down the hatches, make sure that we're well positioned to be able to weather the storm, protect money, and hopefully make some money through the whole piece.
Excellent. So let's talk about a few economies, or what some of the economies, what kind of policies they're implementing to kind of resolve this situation. For example, the U.S., the market data still indicates that the economy is choppy. However, the U.S. dollar remains strong. Oil is recently up because of an OPEC cut. Non-farm payrolls continue to be choppy, but according to the Fed, they're being more positive now. And then the anticipated Fed rate hike. And then we can talk about Europe as well with regards to Deutsche Bank and their huge $14 billion fine by the Department of Justice, which they say they can resolve to around $4 billion or so. I'm not sure how that's going to happen, but the Japanese market as well. Negative rates, it's just not working. If you can just touch on each of these economies and what we're facing now, and just your opinions.
Well, I mean, a couple of things. Let me again go through and sort of pick off a couple of those areas. Number one, the United States. The United States does remain, when you compare it to other parts of the world, other developed economies, Europe and Japan, and so on, it's probably one of the safest and strongest economies. Having said that, the problem with what's going on in the U.S. is they just added another $1.4 trillion at the end of September, their fiscal year, another $1.4 trillion they added to their debt. That's like 8% of their economy. How much did their economy grow by? Maybe 1 or 2%. So even the world's best economy is totally reliant on virtually free money and this rapid rise of debt and deficit spending on the part of the government. So that's the world's strongest economy. Now, then when you go over to Europe and you look at the tremendous problems that they have in Europe, whether they're cultural, the social issues that they have, the indebtedness problems, the non-performing loans, the NPLs, as we refer to them in the business, a lot of the peripheral areas continue to escalate, so that that makes banks more vulnerable because of the increasing potential for write-offs in terms of debt indebtedness. There's virtually no growth over there. And look how much money is being pumped into the system. In Europe, the ECB, the European Central Bank is buying, $80 billion a month of debt. Ray Dalio did his numbers. He said that they only have about 5 years left, and they'll own all the debt, and they'll own 20% of the equity market.
Wow.
They have a runway that is just, you're almost at the end of it. And so, Europe has got real trouble. The Brexit issue with Britain wanting to leave will put more pressure on them, because that's one of the stronger countries. It was heavily subsidizing that whole, socialistic European project. And so that'll put more stress. And then when you go to Japan, as I think most people know, Japan is in a sinkhole. They're in a free fall. They're absolutely, they have massive demography issues in terms of more people dying that are born. Their debt is off the charts. It's 300% of GDP. There's no way they can sustain that. And, their central bank, their Bank of Japan, is in buying, again, all the bonds they can possibly get their hands on. And they also own, as we heard, we were together in Vancouver back in July when Grant Williamson did his presentation at the Sprott conference. It was interesting. He pointed out that the Bank of Japan is the top 10 holder in the 90% of all of the stocks that trade on the Nikkei 225. So to get the Nikkei 225 index, and they're a top 10 holder in 90% of those stocks. So they're in buying stocks through all these ETFs. So when you look around the world, yes, the U.S. on a relative scale is better, but that's when you're comparing it against all of these other very troubled areas. And so from our perspective, U.S. dollar, might go up, put a little pressure on gold, but eventually all paper money will have to get depreciated versus real, tangible, essential, productive assets. And so there's no way to avoid that. When that happens, we don't know, but if we can buy good businesses, again, that create great cash flow off of tangible assets, we think that we've got a recipe to at least protect the investors from massive depreciation of currencies.
Well, it just, we're getting the clear message that governments will do anything by all means to make sure the markets or economies do not collapse. And I guess even the rate of GDP of several of these countries that are very indebted is just not fast enough to service that debt. It's non-serviceable debt. And I guess the last thing you also did mention in your newsletter is to stay away from levered financials. And that's, I think, is a very important point given the derivatives position of some of these banks as well.
Right, and I agree with Mr. Grunlack, the bond guru there, when he says that most of these large global financials are unanalyzable. In other words, they are so complicated. There's no way I can invest in some of these large global banks and even believe that I could possibly understand what's going on in them. I don't think, and we've sort of seen this recently, even the CEO at Wells Fargo or the CEO at Deutsche Bank. We saw this in the credit crisis back in 2008, the CEO of Bank of America or Citigroup or AIG. They didn't even know what's going on in large sections of their business. So this issue of Deutsche Bank, which we mentioned in our report and you also mentioned, I think it's symptomatic of a massive bank that is so interwoven with the system and the structure of Europe in particular, that, and remember, a bank is only as good, especially if it's a big bank, it's only as good as the economy that it's servicing and providing capital for. So you've got this big leveraged beast that's lent money throughout the European zone. Many of those countries are really weak. The non-performing loans are escalating in Portugal, Italy, and some of the other peripheral countries. And the numbers, we look at the NPLs, and it doubled and tripled the last couple of years. And then you get all these derivatives, which no one really knows how to value these. And so you get a bank like Deutsche Bank, and they have over $50 trillion in derivatives. A year or two ago, I read it was like $70 trillion. So you got these massive derivatives on the balance sheet of these banks. So our view is they're unanalyzable. They are very risky. They are leveraged to the hilt. They cannot take any kind of downstroke in the markets, in the assets that they lent money against without wiping out their capital. And so, from our perspective, yeah, sure they might get bailed out, but then what are they going to get bailed out with? If they get bailed out by depositors, that would be a scary situation. If they get bailed out by the German government, which is the ECB, then that just means you're going to print more money and devalue because there is no collateral to back it up with. So from our perch, when we look at the banking mess, and I think Deutsche Bank is just symptomatic of a big picture issues with all of the big global banks, whether they're in France or whether some of the big U.S. banks, we just step back and say we don't need to be there. We're not going to be there. We'll buy financials that are fee-based, and we would rather own the real banks, which in our view are the Franco-Nevadas or the Silver Wheat, and those guys, they're going to have cash flow coming out of their ears. If things get messy and the price of gold and silver go up quite a bit, and in the interim, they're making good money at these prices. So we get all the upside without taking the financial leverage. We want operating leverage.
What I did want to touch on is what we're experiencing now in the markets. As we've discussed the last couple of days and today, gold and silver taking a correction, the market taking a correction, elections are coming up. What are your expectations on how the market behaves over the next several months? And you're seeing the metal sector get corrected right now. A lot of interesting opportunities there. What are you doing?
Well, we just continue to pick away very slowly and carefully. I've had some clients phone and they say, should I double down? Should I jump, in my terms of the exposure to say gold and silver? So no, just be patient. Keep it as a certain allocation in your portfolio. Pick away at the best opportunities. Take a medium to longer term view. These are going to be wonderful, wonderful businesses. Gold and silver as monetary substitutes in this environment will be strong winners. But that is over. You've got to take that 6 months, 12 months. You got to look out a couple of years. That's the way we look at it. We're longer term investors. And so this type of volatility is great. We've got new clients coming in. Now we can pick away at much, much better prices. For existing clients, we try to keep a little bit of room so that we can, again, add a few shares here and there and make sure we go up with more shares than we came down with more recently. But you've got to look at the bigger picture. Don't jump in with both feet. Don't jump out with both feet. Go in 1 foot at a time, pick away, know what you're buying, buy quality, invest in good management, in good assets, in good regions, and don't get scared out. All of the fundamentals, even with this pullback, if you look at the fundamentals behind the scenes, they're actually more supportive of gold and silver today than they have been, in the last 10, 15 years. So these problems are getting more intense, so don't get shaken out. There's some rumors out there that some hedge funds are liquidating. Their hedge funds we know have had a terrible couple of years, and so don't get caught selling and panicking with other people who are panicking. Take a longer term view and keep a good diversified portfolio by quality. So that's what we're doing.
Excellent. Well, if you want to get more information and have a chance to speak with Jonathan, you can visit his website at rocklinc.com. That's ROCKLINC.com. And you can also follow him via his newsletter. That'll be on the homepage, just on the bottom of the homepage, as well as his YouTube, Facebook, and they just have a new app as well. And I believe you have Twitter as well, right? Or no?
Yeah, I have my own personal Twitter
right.
That I will put things up. But also, we do have our corporate Facebook, and you can like that and join on. And we try to post an article or two a day that is relevant to the bigger picture. And yeah, we'll go from there. But also, if you go on our website, you can subscribe, and you'll be on our normal, regular mailing list.
Excellent. Well, thank you, Jonathan, for this great insight, and we'll see how the markets unfold over the next few quarters, and with the elections coming up shortly upon us here. Thanks, Jonathan.
Thank you very much, Sonny, and all the best to your listeners. Stay focused. And don't have a strong investment philosophy, and don't leave that and be influenced by the market vagaries day by day.
Excellent. Thank you.
Okay, bye now.